Well, investors have applauded news, of course, of a partial trade truce between the U.S. and China. But our next guest says a 30% U.S. tariff on Chinese products and resulting supply shocks are still causing uncertainty. He recommends a barbell portfolio strategy, pairing growth stocks with defensive stocks. Andrew Pyle is our next guest. He's Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. Andrew, it's always good to see you. Thanks a lot for stopping by today. Why don't we begin with the S&P TSX Composite Index trading at its highest level ever and continuing its dramatic outperformance of U.S. stock markets. What do you think, and why is this happening?
Well, thanks, Paul. It's great to be here. I think we're continuing to see this rotation of capital out of U.S. markets into non-U.S. markets, whether that's Canada, Paul, obviously Europe, seeing strong outperformance this year with north of 10% gains. Relative to a U.S. market that, while we've had a pretty impressive rally in the last couple of weeks, really leaves this U.S. market behind. And I think investors are shifting to those areas of the Canadian market where we still see some good opportunity. Energy being one of them, even though we've seen oil prices obviously trailing off in recent weeks. We do think energy is still going to be a support for the TSX going forward. Canadian economy is still in solid shape, even though we've moderated. We've got lower inflation. As your previous guests have talked about, the scope is there for interest rate cuts in Canada. And I think we have a pro-growth policy agenda right now in Ottawa. So I think a lot of those reasons really point to the fact, Paul, that investors are looking to Canada to continue to outperform the U.S.
You sound upbeat on the prospects for the Canadian economy. Is that the correct way to characterize your response? We have spoken to an economist earlier today who sees a recession as not her base case, but certainly a possibility that's out there.
Yeah, we don't want to sugarcoat things too much, Paul. I think the probability of a recession in Canada, like the States, is still too close to 50-50 for anyone's comfort level. But I think we are seeing a shift again towards more of a pro-growth policy agenda that will be supportive of growth. We've talked about more resilience amongst Canadian retailers in the last few months as Canadian shoppers alter their behavior and lean more towards Canadian-made products and Canadian-sold products. And I think these are definitely supportive, but I mean, don't get me wrong here. If we were to see a U.S. recession develop, it is going to be somewhat painful for Canada in the near term. It would be hard to escape that. But I think even if we're talking a recession scenario in North America, Canada still probably sees better growth opportunity than what we see south of the border. Okay,
let's talk North American markets at large. It's true that the TSX Composite has outperformed, but the U.S. markets have rallied in a big way since the early or middle portion of April. What do you think of these markets right now and valuations?
I think valuations are rich right now, Paul. I mean, this rally has almost been a straight line moonshot from what we saw coming into May. I would suggest that while we may not see a sharp pullback, I think these markets have to give back some room here. Even from a technical point of view, Paul, I mean, we still do not believe that what we saw in April is the actual bottom for this market. Technicians are going to want to see this market to backfill to see if, in fact, yes, that was the low, and therefore we can build momentum going forward. I think the markets right now, at least temporarily, are overbought. The VIX index right now looks like it could continue to trend higher. We're coming off key technical support for the VIX. VIX at 17, to me, does not reflect the uncertainty that we see in fundamentals. And again, getting back to the recession calls that are still out there.
So you believe a barbell strategy for investors still makes sense? I assume that's the strategy you're deploying on behalf of clients. Remind us what a barbell looks like and what is at each end of your barbell.
Well, I think growth, we still like tech. I think tech valuations are reasonable, so that would represent the growth part of that barbell. But again, be mindful of the fact that we're looking at a moderating economic environment over the remainder of this year. So we want to look at things like utilities, for example, defensive consumer stocks. We don't want to get caught in a trap where we start to load up on consumer discretionaries, only to find that unemployment starts to rise, buying power pulls back, and we start to see that sector deteriorate. So we do like having some defensive. We do want some growth. Our key underlying philosophy right now is that we want to be Canadian dollar centric at this point. We do not want a lot of US dollar exposure. We think the Canadian dollar continues to rise. but we can have that U.S. growth exposure even in Canadian dollars.
I know one thing you're watching, as are many Canadian investors, is the spread between West Texas Intermediate Crude and Western Canadian Select. And with the operation now of the Trans Mountain Pipeline expansion pipeline delivering oil to non-U.S. markets, we are seeing that spread narrow. How important has that been to the performance of the S&P TSX Composite Index?
Extremely important, Paul. If you take a look at the performance of the energy patch in general, relative to WTI, where we would typically see a tighter correlation, we've seen this pronounced pullback in WTI, yet we've seen relatively decent performance amongst Canadian energy producers, whether oil or gas. And as we've discussed previously on other shows, Paul, we still like nat gas overall for the energy play in Canada. And we continue to think that continues to show improvement now with pipelines being built out. And again, discovery of non-U.S. markets, I think, is critically important for Canada. And I think this sector continues to do well.
Do you have European exposure on behalf of your clients? Those markets have outperformed this year.
We do. We came into 2025, Paul, obviously recognizing that U.S. was going to have challenges. We would have challenges too. But we started to build out our European exposure, basically using currency hedged ETFs. And we've also built out emerging markets and developed Asia. Both of those markets have also done well this year. And I think just goes to the point that you need to have a diversified portfolio. Having that exposure in Europe really has insulated portfolios against a lot of the volatility that we've seen coming out of the States.
Okay, what will you be watching for in the bank results, which begin later this week and will continue through next week?
I think loan demand, where the banks are seeing loan demand right now, obviously there's a tremendous amount of uncertainty, some softness in property markets, but we're not hearing anything with respect to, Canadian households panicking at this point. So I think as long as loan demand looks good going into the summer, I think that's a positive. Obviously, analysts will be looking at loan loss reserves, how defensive banks are looking. But I think if everyone steps back right now, including the banks, and looks at the state of the Canadian economy, it's not in bad shape. So again, we'll be watching those loan loss reserves and I guess indications for loan demand.
Andrew Pyle, thank you so much. As always, he is Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. He joined us from Peterborough, Ontario. Well,